When we started the fund, as I said, in 2019, we were looking at, I think around a cash rate of around 0.25. But nevertheless, in the past 12 months, we've been generating returns in excess of 9 to 9.5%, and gradually increasing rates on new loans as they repay and we generate new business. We've also increased our funds under management by around 30% in the last 12 to 18 months. That's helped to defray fixed costs. And so we're on continuing that journey of raising capital to make sure that our fixed cost percentage remains low.
Hi everyone, thank you so much for tuning in for another executive interview. Today we have Frank Vrachas, Managing Director and Head of Finance at the Sydney Metro Fund, a pooled mortgage fund that is offering unique investment opportunities in the private lending space. Frank, thanks for joining me today.
Thank you and welcome.
Now, Frank, before we dive into the details of the fund, I think our viewers would be interested in hearing more about your personal journey. So can you tell us about your background in the finance industry and how the Sydney Metro Fund came about?
I'm a chartered accountant and I have been for over 40 years. I was a registered company auditor and tax agent, amongst other registrations. And I ran an accounting practice in Sydney CBD for over 25 years. I was a co-managing partner until I retired from the profession in 2022. During that time, I was involved in all range of business and finance transactions and had a lot of experience in the finance world, both from an investor's point of view and from a borrower's perspective, assisting clients, I helped a couple of clients who actually established mortgage funds for the last 10 years or so, and in many cases helping clients to raise funds. This particular fund came about because I was looking towards retiring from the profession, and at the time cash rate was below 0.5%. I also had family members who were hassling me to do something to help them generate more income from the return on their superannuation and investments. And so it came about from there with my own funds and two siblings and a couple of associates, and we got the fund up and running in 2019. It's been performing pretty well ever since. And I must say that both my siblings are retired and are living reasonably comfortably off the return from the Sydney Metro Fund. But of course, we've grown since then, and we're looking to continue that process.
Absolutely. Thanks for sharing that, Frank. It's always insightful to understand the expertise behind a fund. Now, let's talk about the fund's performance. So, the Sydney Metro Fund targets returns of the RBA cash rate plus 6.25% per annum, which is quite attractive in today's market. So, how has the fund performed against this target, and what strategies do you employ to achieve these returns?
When we started the fund, as I said, in 2019, we were looking at, I think around a cash rate of around 0.25, and we were able to quickly achieve targets because of those low cash rates. But as the RBA rapidly increased interest cash rate in 2022-23, in fact, it caught a lot of businesses off guard, and it was the largest and most sudden increase in interest rates in the cash rate for many decades. And as our business was based on fixed loans, it was difficult for us to just increase rates to the borrowers like most banks did with their mortgage rates and their variable rates. But nevertheless, in the past 12 months, we've been generating returns in excess of 9 to 9.5%. And gradually increasing rates on new loans as they repay and we generate new business. We've also increased our funds under management by around 30% in the last 12 to 18 months. That's helped to defray fixed costs. And so we're on continuing that journey of raising capital to make sure that our fixed cost percentage remains low and that we continue to go for that target of 6.25. And I expect as the rates as we got caught on the way up, when rates were increasing rapidly, as they come down, they won't drag us with them. We will be able to maintain our rates. Our margin will increase as the cash rate reduces.
Now let's talk about the backbone of your fund, the loan portfolio. So can you elaborate on this, and what type of businesses typically borrow from the fund, and how do you assess and manage the risk that are associated with these loans?
Well, we have a fairly diverse range of business types that we deal with. All our loans, though, are non-code, which means that no loans are for private use or personal use. We don't lend on home loans or home renovations, or boats or cars or all those sort of personal assets. It's all business related. Some of the businesses we've lent to include gyms, we've done medical centres, we've had a battery manufacturer, a seafood wholesaler, Domino Pizza franchisees. In fact, there was an accounting practice acquisition, investors, property investors, and many types of others. And the main way we minimise risk is predominantly through security. Having adequate security, we make sure we have independent valuations of real estate security, whether they're a first or second mortgage. We certainly want to see financial statements and tax returns. We do credit checks, asset and liability statements. And yes, we do all that, but we certainly don't have the same strict guidelines that a normal bank criteria would fall into. But we are much faster, and that's in many cases helped our clients along the way that we're in time difficulty.
Thanks for that comprehensive overview, Frank. Now, we are all aware of the current economic climate and its challenges. So, how does the Sydney Metro Fund position itself to provide consistent returns while managing potential market volatility?
Our business or industry is probably more dependent on how rigid the banking guidelines are as against what the economic conditions are. As long as the banks maintain their strict lending guidelines, which I can't see changing, I would expect that they even become more stricter, because as the economic conditions worsen, the banking guidelines become stricter. And the more strict the banking guidelines are, the more opportunities there are for businesses like ours. And to be honest, since I've been in business, as I said, over 40 years, there's always been a market for non-bank lenders in various forms. In the early days, it was completely unregulated and was managed through the legal profession and accounting profession. But today it's a little bit more regulated.
Well, it's clear that you have a robust strategy in place. Now let's talk about something that's crucial for investors, which is the liquidity. So can you discuss the fund's approach to liquidity management, particularly in light of your monthly distribution model?
We allocate profit and returns to investors on a monthly basis to their account, but we distribute quarterly cash. Cash distributions go out quarterly. Our interest receipts are very reliable and very predictable. Because we either have prepaid interest on loans or monthly interest in arrears. So we're pretty comfortable in being able to predict our cash inflows. We have very few variable costs, so we can predict our outflows quite comfortably. And also, at least half of our investors are reinvesting their returns every month. So our funds under management are growing monthly generically rather than having to rely on additional investors. Fortunately for us and all the businesses that I've seen, where we have contracted income and very few variable costs, it becomes pretty easy to predict cash flow. And the only thing we really have to manage well is we need to be able to have as much of our funds lent out as possible in order to maximise returns, but also allowing for the cash flow to cater for withdrawals. At this stage, we've only had one withdrawal from a fund from an investor in the time that we've had the funds, and we have very strict withdrawal windows, so we can manage that cash flow quite comfortably.
That's very insightful, Frank. Now, I'd like to tap into your extensive experience. So, with your background in non bank mortgage origination, how do you see the private lending market evolving? And and can you also tell us how is a fund positioned to capitalize on these trends?
I expect that this industry, the mortgage fund industry, private sector, is on the verge of becoming a much more regulated industry. ASIC's already indicated that it's an area that they're reviewing. They're a bit concerned that the barriers to entry are quite low, and so they will be implementing further regulations. Our trustee company, which I control, and myself are already licensed with ASIC. We have an AFSL license, and our processes and documentation has been established in a way to allow for a regulated organisation. This includes the information memorandum we have, which we had prepared from a expert legal firm in this space. And we also have all our compliance and documentation processes reviewed and controlled by a legal firm who specialises in the financial services industry, and that's an ongoing service that we take. And I found that when regulation in industries occurs like this, the marginal businesses tend to fall away, and the good operators and businesses tend to get stronger. And certainly we're striving to be in that the later phase, which is in the stronger and well-regulated, documented businesses. But having been a company auditor and a tax agent for 40-odd years, I understand regulations. I lived by regulations most of my business career. And I'm actually welcome a more regulated industry, which will give confidence to investors in these types of funds.
Absolutely. Now, Frank, looking ahead, what opportunities or challenges do you foresee in the private lending market, and how is Sydney Metro Fund preparing for these?
Probably the biggest opportunity is the consolidation of the banking industry. Recently ANZ acquired Suncorp, and I expect there'll be more of those sorts of acquisitions. And whenever that's happened in the past, the lending guidelines of the smaller bank have been upgraded to the lending guidelines of the larger bank. So then you now have more stricter lending guidelines and processes in place, which should open up the second-tier market even more than it is now, despite any sort of regulations coming in from ASIC. And I expect that as economic conditions deteriorate, and I don't expect them to go that badly, but they're certainly on the way down at the moment, we would see more demand for our type of lending.
Absolutely. Well, Frank, thank you so much for sharing your valuable insights. Your expertise and the fund's innovative approach certainly offer an intriguing opportunity for sophisticated investors looking for consistent returns in the private lending space. Now, for those who are interested to get in touch with the team at the Sydney Metro Fund, please see the details at the side of your screen or in the description of this video. Once again, thank you, Frank, for coming on and sharing your insights. And our team wishes you all the luck with your venture moving forward.
Thank you, and a pleasure being on, and thank you for the opportunity.